Let's discuss Bitcoin's network effect because I think it's important to understand why the price could, very high. It's highly likely the price will continue to rise over the long term. Um, so I want, utilizing AI, I typed in a question. The question was, can you discuss Bitcoin and network effect? And the response is Bitcoin's network effect is the core reason its value, resilience, and adoption have grown over time. As more users, holders, and merchants participate, the system becomes more useful and harder to displace. What the network effect means for Bitcoin. A network effect occurs when a product or system becomes more valuable and as more people use it. Classic examples include telephones and the internet, where each additional user increases the number of possible connections. This dynamic is often modeled using Metcalfe's law, which states that a network's value grows roughly with the square of its number of users. Bitcoin exhibits this same phenomenon. More users, more liquidity. More liquidity, more merchants and institutions willing to accept or hold Bitcoin. More acceptance, more users join. This feedback loop strengthens Bitcoin's position as a monetary network. Morningstar notes that network effects are one of the strongest economic moats in any system, and Bitcoin's value can be modeled from the bottom up using network effect frameworks. Evidence of Bitcoin's growing network effect. Research shows several reinforcing trends. User base expansion, the number of Bitcoin addresses holding Bitcoin has reached tens of millions, and daily active addresses approach 900,000. Longer holding periods. Over 63% of all Bitcoin supply has been held for at least 1 year, indicating strong conviction and reduced circulating supply. Institutional adoption. Large holders, 1,000 plus Bitcoin, are at a record highs, reflecting growing institutional participation. Fixed supply plus rising demand, with 88% of all Bitcoin already mined and annual supply growth at just 1.3%, increasing network participation has an outsized impact on price dynamics. These factors combine to create a powerful monetary network where adoption and scarcity reinforce each other. Positive versus negative network effects. Bitcoin's network effects aren't purely positive. Research highlights a paradox. Positive cross-side effects. More merchants accepting Bitcoin increases its usefulness for consumers, and vice versa. Negative effects. High price volatility discourages spending and can slow adoption. Despite this, the number of merchants accepting Bitcoin has continued to rise, even when volatility spikes. This suggests that Bitcoin's network effect is robust enough to overcome short-term frictions. Why the network effect makes Bitcoin hard to displace. Lynn Alden's analysis emphasizes that Bitcoin's network effect forms a deep moat. Competing cryptocurrencies must replicate not just the technology but the entire user base, liquidity, security, and trust network. Because Bitcoin's value grows quadratically with users, a late starting competitor faces exponential disadvantages. This is why Bitcoin remains dominant despite thousands of alternatives. Bottom line, Bitcoin's network effect is one of the strongest in modern finance. It increases Bitcoin's utility, liquidity, and perceived safety. It reinforces Bitcoin's role as a store of value. It makes Bitcoin extremely difficult to replace. So then they asked a question, and I responded. I wanted to learn more about how it influences long-term price behavior. How the network effect influences Bitcoin long-term price behavior. Bitcoin's network effect strengthens its long-term price behavior by increasing demand faster than supply, reducing volatility over time, and amplifying the impact of institutional adoption. Below is a structured, evidence-based breakdown of how this happens, grounded in current research and market data. Network growth correlates with major price movements. Academic analysis shows that structural changes in Bitcoin's transaction network often accompany significant price changes. Researchers constructed Bitcoin's transaction graph and found that shifts in the activity of core users align with major price movements, indicating that network expansion and price appreciation reinforce each other. This means more active users, more liquidity. More liquidity, higher price stability. Higher stability, more adoption. More adoption, higher long-term price potential. This feedback loop is the essence of Bitcoin's network effect. Network effects reduce long-term volatility. S&P Global reports that although Bitcoin remains volatile, its volatility is on a long-term downward trend, partly because deeper integration with traditional finance, ETFs, futures, institutional custody stabilize the market. A growing network increases market depth, reduces the impact of large trades, and encourages long-term holding behavior. As the network matures, Bitcoin behaves more like a macro asset, hedged against long-term currency debasement rather than a speculative instrument. On-chain networks metrics help forecast long-term price floors and ceilings. Bitcoin Magazine highlights that network-derived metrics such as CVDD, balance price, and realized price have historically predicted Bitcoin's long-term cycle low and highs with strong accuracy. These metrics rely on holder behavior, coin age distribution, network activity, realized values of coins moved. Because these are network effect variables, they directly tie Bitcoin's long-term price trajectory to the strength of its user base. Institutional adoption accelerates the network effect. By 2025, institutional Bitcoin adoption reached 58 billion via ETFs, with the corporations holding 6.2% of total supply. This institutional influx has increased demand, reduced circulating supply, lowered volatility by 75% compared to earlier cycles, supported price stability around 112K in 2025. Investors join the network effect, or dramatically amplify. Institutions joining the network dramatically amplify the network effect because they hold large amounts for long periods, require robust infrastructure, custody, regulation, and liquidity, and signal legitimacy to other market participants. This creates a self-reinforcing adoption cycle that pushes long-term prices higher. The network effect affects paradox versus volatility versus adoption. Research shows a paradox. Bitcoin's price volatility should reduce merchant adoption, yet the number of merchants accepting Bitcoin continues to rise. This suggests the positive network effect, more users, more value, outweighs the negative effect, volatility. Long-term adoption persists even during volatile periods. This resilience strengthens long-term price behavior. Bottom line, how the network effect shapes long-term price. Bitcoin's long-term price behavior is dominated by its network effect, which influences price through network effect component and impact on long-term price. Growing user base increases demand and liquidity. Institutional adoption stabilizes price, reduces volatility. On-chain holder behavior, predictable cycle, lows and highs. Merchant adoption expands real-world utility. Scarcity plus rising demand, structural upward price pressure. The stronger the network, the stronger the long-term price trajectory. So we'll stop it there. I just want to discuss the network effect because it's just important to understand how it's very important for Bitcoin and how it's. To me, it actually kind of the network effect of Bitcoin is sort of like, compound interest to. In the stock market, it's very similar. Long term, they basically are very, very positive for the for Bitcoin and for the stock market. So anyway, that's all I got today. Hope you have a wonderful day.